If your savings are sitting in a big-name bank account, there's a strong chance you're earning almost nothing on it, while that same bank turns around and lends your money out for a lot more. Today, we're doing the actual math on what that's costing you and showing you the simple fix that takes about 10 minutes. Most people think of losing money as something dramatic, a bad investment, a scam, an overdraft fee. But one of the most common ways people lose money is completely silent, leaving cash in an account that pays almost no interest. There's no red flag, no warning email, nothing that feels like a loss. It just quietly happens every single month, and most people never notice because nothing seems wrong. Opportunity cost is simply the gap between what you're earning now and what you could be earning elsewhere for doing nothing extra, same safety, same liquidity, just a different account. Traditional brick-and-mortar banks have historically paid extremely low interest on standard savings accounts, often a small fraction of a percent. Meanwhile, high-yield savings accounts, typically offered by online banks or online divisions of larger banks, tend to pay meaningfully more, sometimes many times more, for holding the exact same type of FDIC-insured cash. Let's use a simple, hypothetical example, not a specific real rate, just round numbers to illustrate the concept. Imagine you have a chunk of savings sitting in an account paying almost nothing. Over a year, that near-zero rate might generate just a few dollars in interest. Now imagine that same amount sitting in a high-yield account paying a meaningfully higher rate. The difference over a year could be substantial, and it compounds the longer you leave it there. The exact numbers will depend on your balance and current rates, but the pattern is the same: more money for doing nothing different. This isn't an accident, it's a business model. Large traditional banks often have extensive branch networks, staff, and overhead to cover, and many customers simply never move their money, so there's little incentive to compete on interest rates. Online banks, on the other hand, often have lower overhead since they don't run physical branches, so they can pass more of that savings back to customers in the form of higher interest rates on deposits. A high-yield savings account isn't a different, riskier product. It's still a savings account with the same basic function, a safe place to hold cash you might need access to. The key things to look for are whether it's insured, FDIC for banks, NQA for credit unions, whether there are any monthly fees or minimum balance requirements, how easy it is to transfer money in and out, and how the rate compares to other options currently on the market, since rates change over time as broader interest rates shift. For most people, moving cash from one insured account to another insured account isn't adding risk. It's the same protection, just a better rate. The main things to double-check are that the new account is properly insured up to the standard limits, that you understand any transfer times or holds, and that you're not giving up something you actually need, like in-person branch access, if that matters to you personally. In practice, this usually looks like: research a few reputable high-yield savings options, compare their current rates, fees, and insurance status, open the new account online, and then transfer your savings over, often electronically, sometimes taking a few business days. Many people keep a small buffer in their everyday checking account for bills and immediate access, while moving the bulk of their emergency fund or extra cash into the higher yield account. Before switching anything, take a moment to compare a few current offers side by side, read the terms on fees and minimums, and make sure the account is properly insured. This video is meant to help you understand the concept and ask the right questions. It's not personalized advice, so take a few minutes to check current details before moving real money. At the end of the day, this isn't about chasing the highest number you can find. It's about not leaving free, safe money on the table simply because you never got around to checking. If this helped you look at your savings differently, hit subscribe for more clear, practical breakdowns on brokerages, accounts, and everyday money decisions. And I'll see you in the next one.